Kia ora, I'm Mary Jo, Kiwi Bank economist. So it's hard to believe that it's been over a year since the COVID pandemic began. But the good news is we've gone from counting COVID cases to counting COVID vaccines. Nearly 2 billion vaccine doses have been administered so far, and the success in managing the virus has allowed economic activity to resume after many months of countries being under lockdown. Now underpinning the global economic recovery has been outsized policy support from both governments and central banks. Monetary policy was quick to relieve stresses building in financial markets, and over 16 trillion has been spent in global fiscal support through business loans, income support, and cash handouts. There's no doubt that quick, swift policy action has helped to prevent far worse outcomes. Basically, because of this, the global economy experienced a much smaller contraction than we initially feared last year, and we're now seeing a stronger vaccine-powered recovery unfold. So against a much improved global economic backdrop, we've upgraded our forecasts for the New Zealand economy. Despite the closed borders, activity indicators suggest that we may have avoided a double-dip recession. Strong commodity prices continues to support our export sector, and the travel bubble with Australia should ease some pain within our tourism sector. And with infrastructure projects still in the pipeline, economic growth is expected to take off into next year. Now, in terms of the labour market, we think that the unemployment rate has already peaked in the current cycle. From here, the improved economic outlook and restrained growth in labour supply because of the closed borders should see the unemployment rate trend lower, nearing that pre-pandemic 4% by 2024. And that's an exceptional result. To have experienced the deepest recession since the Great Depression and come out the other side with a peak of just 5.2%. Now lastly, inflation is expected to jump in the near term because of the ongoing supply chain disruptions and base effects in play when prices actually fell this time last year. But looking through all this, we expect spare capacity in the economy to be used up quickly, and that should see inflation return to the Reserve Bank's 2% target midpoint. Indeed, with the way the economy has been tracking, it's given the Reserve Bank confidence to lay out the pathway back toward a normalization in monetary policy. In fact, they've made clear that the next move in interest rates, all going well, is up. Overall, the upside risks to growth have strengthened. 2020 was the year of the virus, this year is the year of the vaccine, and hopefully next year we'll see more movement and freedom in international travel. That's it for me this week. Be sure to check out our latest Outlook note and fresh forecasts that are available on our website. Talk to you in the next video.